There is a version of financial responsibility that feels completely logical on the surface. You work, you spend carefully, you set aside whatever is left, and you watch that number in your savings account slowly climb. It feels like progress. It feels like discipline, and in many ways it is. But there is something happening underneath that number that most people are never shown, something that does not appear on your bank statement, and is never mentioned in the congratulatory email your bank sends when your balance hits a new high. Your savings account, the one you were told to build and protect, is quietly losing value every single year, not because of fees, not because of fraud, but because of a force that is older than modern banking itself. That force is inflation, and understanding how it actually works, not the textbook definition, but the mathematical reality of what it does to stored money over time, changes the way you think about every dollar you choose to hold versus every dollar you choose to deploy. Inflation is most commonly explained as rising prices, and that explanation is accurate but incomplete. What inflation really describes is the declining purchasing power of a unit of currency over time. When the inflation rate is 3% in a given year, it does not simply mean that groceries cost 3% more. It means that every dollar you are holding is now worth 3% less in terms of what it can actually obtain in the real world. The dollar did not disappear. The number in your account did not change, but its relationship to goods, services, labor, and assets shifted, and it shifted against you. The average savings account in the United States has historically offered an interest rate somewhere between 0.3 and 0.5% annually during normal rate environments. There have been periods, particularly in the years following the 2008 financial crisis and again through the early 2020s, where rates sat functionally at zero for extended stretches. During those same periods, inflation averaged between 2 and 4% annually, with notable spikes well above that range. The math here is not complicated, but its implications are rarely stated directly. If your savings account is returning 0.4% and inflation is running at 3%, your real return, the return that actually reflects purchasing power, is negative 2.6%. You are not earning. You are losing, slowly, invisibly, and consistently. To make this concrete, consider a simple illustration. Imagine you place $20,000 into a standard savings account and leave it untouched for 10 years. At an interest rate of 0.4% compounded annually, that account grows to approximately $20,812. On paper, you made money. But if inflation averaged just 2.5% over that same decade, the purchasing power equivalent of your original $20,000 would need to be approximately $25,600 to buy the same basket of goods it could have purchased when you first made the deposit. You started with $20,000 in real terms, and you ended with what is effectively worth less than $16,000 in the purchasing power of that original moment. The account grew. Your wealth did not. This is not a glitch in the system. It is the system functioning exactly as designed, and understanding who benefits from that design is an important part of financial literacy that rarely gets discussed in mainstream personal finance content. When you deposit money into a savings account, the bank does not simply hold it. The bank uses that capital, lending it out at rates dramatically higher than what they pay you, investing it in instruments that return multiples of your deposit rate, and profiting on the spread between what they earn on your money and what they pay you to keep it there. Your low interest rate is not an accident or an oversight. It is the margin that makes the banking model profitable. You are, in a very real sense, providing low-cost capital to an institution that deploys it far more aggressively than your account terms would ever suggest. The psychological mechanism that keeps most people in this arrangement is the conflation of safety with growth. A savings account feels safe because the number never goes down. There is no volatility, no red days, no news cycle that threatens the balance. And that feeling of safety is genuinely valuable. Liquidity and capital preservation serve real purposes, particularly for emergency funds and short-term financial needs. The problem is not that savings accounts exist. The problem is when the savings account becomes the destination for money that has no near-term purpose, money that could be working in a compounding environment instead of slowly eroding in a static one. Behavioral economists have a term for this tendency. It is sometimes called money illusion, the cognitive bias that causes people to think in terms of nominal values rather than real ones. When your savings account balance increases by $200 over the course of a year, your brain registers a gain. The number is higher. Progress has occurred. but your brain is not automatically calculating what that $200 represents in real purchasing power terms, and whether the value of what you hold has actually grown or quietly contracted. Money illusion is not a character flaw. It is a predictable feature of how human cognition processes numerical information, and financial institutions understand this very well. The historical record on this is consistent and spans well beyond recent memory. In every decade since the mid-20th century, the average return on cash savings has trailed the inflation rate during at least one significant multi-year period. The 1970s saw inflation climb into double digits, while savings rates, though nominally higher, still failed to keep pace with the full erosive force of that era's price environment. The 2010s presented the opposite extreme, ultra-low inflation paired with near-zero interest rates. But the spread between the two still consistently disadvantaged the passive saver. The environment changes, but the structural relationship between savings account returns and real purchasing power has remained persistently unfavorable for those who treat their savings account as a long-term wealth vehicle. What the data points toward, consistently, is that the role of a savings account in a rational financial architecture is narrow and specific. It is a holding place for capital that needs to remain liquid and protected over a short time horizon, typically 3 to 6 months of living expenses held as an emergency reserve, plus any funds allocated for a purchase or obligation within the next 1 to 2 years. Beyond that function, every additional dollar sitting in a savings account is a dollar paying a quiet inflation tax, while alternatives with meaningfully higher expected real returns go unused. Those alternatives carry their own complexities and their own risks, and none of them come with the psychological comfort of a stable, insured balance. But the absence of visible risk is not the same as the absence of actual risk, and the slow, invisible erosion of purchasing power is a risk just as real as market volatility. It simply does not announce itself with the same urgency. Understanding that distinction, and learning to weigh real returns rather than nominal ones, is one of the foundational shifts in how people who build wealth over time think about money differently from those who simply accumulate it. The savings account is not the enemy of financial health, but treating it as the finish line, as the place where money goes to be safe and to grow, is a misunderstanding of what it actually does over time. The number climbs. The purchasing power does not always follow. And the gap between those two things, compounded across years and decades, is where a significant portion of the wealth that could have been built simply disappears instead.